Me and my group are going to present the NextEra Energy SPA. So starting from the intro, we can see that the NextEra Energy SPA is an American electric power infrastructure company that is headquartered in Florida, and it serves mainly North America, so basically USA and Canada. Moving on to the next slide. We can see that basically NextEra Energy is a Fortune 500 company that is one of the largest energy companies in the US, and it basically is involved in many activities such as transmission, distribution of electricity. And it's also very active in modern day issues such as, for example, gender equality representation, such as, for example, the fact that 25% of its management is composed by women. And also by, for example, the employee engagement index, which is pretty high. Moving on to the next slide. We can see that its strategy is basically based on three characteristics, such as basically using energy resources and technologies to provide a sustainable alternative to the fossil fuels, and is also recognized worldwide by being basically world's largest generator of renewable energy. And it's also characterized by the fact that its strategy is based on building also a resilient energy infrastructure with its large portfolio of power plants, and also by delivering outstanding quality values to its customers. As a matter of fact, its revenue in 2022 was basically $20 billion. Moving on to the next slide, its business model is characterized by an integrated approach, by utility operations, by an objective of growth and expansion, and by an emphasis on research and development. Moving on to the next slide. We can see that the ownership structure is characterized by three qualities. We can have the institutional ownership held by institutional investors, including mutual funds, pension funds, individual ownership on basically individual shareholders who purchase the company stock through direct investments, and executive and insider ownership. That may include, for example, top-level executives, board members, and others. Moving on to the next slide. We can see that the corporate governance is pretty different than the others. We can see that it maintains a two-tier governance structure that is characterized by the presence of an executive board, which manages the company, and a supervisory board, which advises and monitors, obviously, the activities done by the executive board. Moving on to the next slide. The NextEra Energy SPA, basically, the board advises and supervises the executive board. And also the board is characterized by the presence of 9 members elected by the shareholders at their general meeting, and 9 members representing the US employees of the NextEra group. The executive board is the governing body of the company, and it's subject also to the requirements of the stock corporation law. And also it has to be committed to do the company's interest and company's policies, obviously. Going to the next slide. We can talk about the market, so basically the renewable energy, which is expected to grow in the US at least significantly in the next 15 years, with a projected growth of $971 billion in 2022 to $2 trillion by the end of the decade. This growth is characterized by the fact that it's driven by a series of factors, such as the increasing competition between among obviously renewable energy companies and technology, obviously, by government policies that support renewable energy development and growing consumer demand for clean energy. Moving on to the next slide, we can see basically how it's changing the industry in the coming years, with several investments in different fields, such as machine learning, hydrogen power, and also several emphasis on basically on SEG criteria that is required broadly speaking, among all companies, not only in the renewable energy field. Moving on to the next slide. Here, basically, we decided to analyze the performance of NextEra Energy by comparing it with other free ETFs with the largest market capitalization. So from the graph, we can see that basically the trend is pretty constant, and the NextEra Energy has the most consistent trend over time, despite being also subjected to several shocks periods, such as, for example, the 2008 crisis, the COVID-19, and especially the war between Ukraine and Russia. So I will leave the floor to my next colleague.
We'll go through a really careful analysis of the free statement based on the past 5 years of historical data, starting from the balance sheet. Then we will go through the income statement, and finally we will carefully study the cash flow statement. From a general starting point, we can say that the free statement of the NextEra Energy company has been growing steadily over the past 5 years. The company revenue, net income, and free cash flow have all increased at a CAGR of 5.2% for the revenue, and then going on 5% and 5.6% respectively. The company financial statement are growing really fast, and this is due to the really good ability of the management team and the possibility to generate strong cash flow all the year. The business is not seasonal, and this is a really important starting point for the future growth. Starting from the balance sheet, as we can see from this table, we study the data from the 2018 fiscal year to the 2022 fiscal year. The assets have grown at a compound annual growth rate of 5.4% over the past 5 years, and this is essentially driven by the company investment in renewable energy market. And then going on to the liability side, also these parties have grown at a CAGR of 5%, and this is essentially due to the situation of the debt financing acquisition, but they are working to repay this important situation. And finally from the equity side, the total value of the equity has grown at a CAGR of 5.7%, and this is driven essentially by the company earning and share repurchases. Going on, now we can study the income statement. The situation is quite similar compared to the balance sheet. The revenue has grown at a compounded annual growth rate of 5.2% over the past 5 years. And this is essentially thanks to the situation in the renewable energy market. From the table, the company now is performing super well compared also to the pre-pandemic situation. Now we have $23 billion compared to the $20 billion in 2018, and the 21 billion from the pre-pandemic situation. In particular, we have 3 important indicators from the income statement: the revenue, as we stated before, and then we have the net income that is performing super well. We registered a growth in this value of 5% over the past 5 years, and this is essentially due to the increasing in revenue, but also a really important effort to control and reduce the cost. And then the EPS, as we can see later from my colleagues, is growing a really important CAGR of 5% in average per year, and this is driven by the increasing in net income. This is a really strong sign of good health of the firm, and then thanks to the share program. Then this is really important. Then we will use this data in our valuation, in our DDM. We have the cash flow statement. The operating cash flow has grown at a 5.5%, and this is the highest value in the market compared also with the main competitors. And this is essentially thanks to the really important work that the company is doing in its core business. And then the free cash flow, that is the starting point of the discounted dividend model. We have a 5.6% of growth, and this is really important because it's an important sign of control in capex and an important increase in operating cash flow. Now we try to perform and run some financial forecast based on revenue growth and earning per share, starting from the last fiscal year, the 2022, according to our estimation, based also on the study of the core business and the core market. We try to give you a carefully study of the balance sheet and the income statement and the cash flow statement, and we performed a simulation based on the best scenario of plus 16% in revenue growth from 2022 to 2023, and also an incredible plus 50% of EPS growth from 2022 from 2023. And this is essentially driven by the situation in the core market, because after the war in Ukraine and the increase in the oil price market, the renewable is super fast. And based on our estimation, we have now this incredible data. Starting from revenue of 2,000 billion in 2022, we will arrive at a value of $33 billion in 2027. And this situation is quite similar to the earning per share, starting from $2.10 in 2022, we will arrive at $5.50 per share in 2027. And as we can see from this table, a scenario based on the situation in the core market of plus 33% in 2023. And then going on, this is a zoom in the EPS situation, as we stated before. And I think we can going on. And now we will leave the stage to my colleagues, Michele, that he will disclose the stock analysis situation.
Now, to carry out an investment analysis based on performance and cost of capital, we will apply the famous capital asset pricing model. The main objective of the capital asset pricing model is to calculate the expected return on an investment by considering its systematic risk, that is, the risk that cannot be diversified. The basic framework is that expected return on investment is determined by adding the risk-free rate, denoted as RF, to risk premium, based on the systematic risk of the investment. Systematic risk is measured using a factor called FI, which reflects the impact of common market-wide risk factors affecting all firms in the economy. However, in our case, for precision and currency, we are not content to consider only market risk. So we have decided to opt for a multi-factor capital asset pricing model, which had additional risk-free risk factors in addition to market risk. This change has led us to have better, more comprehensive risk assessments benefits, allowing us to make more informed decisions appreciating the complex nuances of investments, as well as a more accurate estimate of expected return and fair value. As a result, we can better assess the true value of an asset, moving away from potentially overvalued or undervalued assets. It also allows us greater flexibility for market conditions and investment strategies. In fact, the strength of the multi-factor capital asset pricing model lies in its adaptability, and we have the freedom to select and include relevant risk factors based on specific market conditions or our unique investment strategies. The elements of the formula will be epsilon T, that is idiosyncratic risk that represents the specific risk of a single security, which is assumed to be uncorrelated with the broader risk factors considered in our model. Our goal is to gain valuable insights into how changes into NextEra Energy stock occur in response to various market factors. we choose to adopt the multi-factor capital pricing model, incorporating the market benchmark, exchange rates, and other key risk factors. The 15-year time horizon from June 19, 2008 to June 19, 2023 was carefully selected to encompass a wide range of economic conditions, including those during periods of economic shocks. This comprehensive approach gives us a total view of NextEra Energy's performance. To begin our analysis, we downloaded the time series of NextEra Energy stock price over the selected period and calculated logarithm returns. Logarithm returns provide us with a more accurate representation of the growth of the business by considering the compound effect over time. Now, to determine the risk-free rate, we turn to US Treasury securities, which are traditionally considered relatively risk-free, and we examined two options for the risk-free rate. The first is 0.038, and the second, proposed by Damodaran, that is 0.035. To find a balance between these two values, we decide to take the average of these two rates. This choice ensures a balanced representation of the risk-free component in our model. The crux of our analysis lies in the estimation of the risk premiums that they are represented by beta 1, beta 2, and beta 3. These coefficients are correlation coefficients that capture the relationship between NextEra Energy stock and the respective market factors, the SP 500, USD Euro exchange rate, and the USD JPY exchange rate. To calculate these risk premiums, we use the ordinary least square, OLS technique. That is a method widely used in finance to estimate coefficients in linear regression models. With the essentials in place, we now calculate the excess returns of NextEra Energy and the other market indexes. Excess returns are the difference between asset returns and the risk-free rate, and they represent the reward for taking on additional risk. These excess returns play a key role in assigning the performance of our investment relative to its risk exposure. Having obtained the betas, we understand how NextEra Energy responds to various market factors, and we are able to get insights into its return potential and can make more informed investment decisions. In this slide, we have included two graphs obtained with Python that provide us with valuable insights into observed returns over a 15-year time frame. The first, on the left, give us insight into trends and allows us to identify periods of high or low returns and to assess the volatility of different stocks. In particular, we can see that the stock that stands out for its steady performance and minimal fluctuations is precisely NextEra Energy. The graph on the right shows us logarithmic scale returns of the NextEra Energy stock and the stocks that we have used to calculate the regressors. We can see that what our analysis has shown, that is the positive correlation between SP 500 and NextEra Energy, is confirmed by observing the performance of the two stocks. On this slide, we can see we have other three graphs that we have made always with Python. And on the left graph shows us the historical closing prices of NextEra Energy stock over the indicated time interval. The x-axis represents the dates, and the y represents the closing prices. The graph provides a visual representation of price fluctuations over time, and we can see that the most noticeable fluctuations occur from 2020 onward, but we can explain this as a cause of the shocks of the last few years. The pandemic and the war in Ukraine, especially the latter of which shook the energy sector severely. We can check the validity of the above by looking at the charts on the right that show us the 50 and 200-day moving averages, which give us a more accurate indication of trends and help smooth out short-term fluctuations in the stock price. Especially useful is the chart of the 200-day moving average, which makes us realize that actually over a larger time sample, the fluctuations are not very noticeable, but rather the stock price has a fairly constant trend. Now we focus on NextEra Energy's price to book, PB ratio, which stands at 3.57. This ratio measures a company market value relative to its book value, reflecting investor sentiment toward the stock. A PB ratio below the industry average of 3.8 indicates that the market currently values NextEra Energy assets at a relatively attractive price. This suggests that the stock may be undervalued relative to its industry peers, making it an attractive proposition for value-oriented investors. In the following slide, we have included 3 graphs. The first one on the left showing total shareholder return in comparison with SP 500 utility index and SP 500. The other 2 on the right showing us adjusted earnings per share from 2006 to 2022, and the last one showing dividends per share from 2006 to 2022. All the information was taken from NextEra Energy's investor analysis. Based on NextEra Energy's solid performance and strategic initiatives, we expect adjusted EPS growth in the impressive range of 6% to 8% over 2022 adjusted EPS. This growth trajectory reflects that NextEra Energy continued commitment to excellence, innovation, and efficiency. With this growth, the company aims to create a listing value for the shareholders and strengthen the position as an industry leader. In addition, from 2021 to 2025, company expects average annual growth in operating cash flow to equal or exceed the compound annual growth in adjusted EPS. This alignment between operating cash flow and EPS growth is indicative of a financially sound and well-managed organization. By generating strong operating cash flows, the company can increase its ability to invest in strategic initiatives, new ventures, and technology that lead the company to success in a dynamic marketplace. Now I leave the floor to my colleague.
Regarding the strengths and the challenges, we can start by analyzing the social and economic environmental performance. As we know, NextEra Energy has a strong commitment to society through a number of initiatives in order to improve the communities that it's helping. Regarding the environmental impact, we can say that basically the company is investing strongly in new technologies that will help to further reduce its emissions, and also it's committed through a series of initiatives and programs to protect the wildlife and habitats. Regarding the social issues, the main objective of NextEra Energy is basically creating a safe work environment through, for example, a comprehensive safety training program from all its employees, covering a series of topics, and is also committed to creating a diverse, inclusive workplace with a number of programs that basically aim to promote diversity inclusion, including a mentorship program for women and minorities. Regarding the economic impact, we can see basically that NextEra Energy has implemented also a series of different initiatives, such as, for example, investments in renewable energy and infrastructure, and has been able also to control its cost, which basically help, financially speaking, the company to boost its earnings, and also has diversified its business by investing in a variety and of diverse energy sources in order to compete even more with its peers in the market. Moving on to the next slide, we can see that the strengths basically revolve around the 3 aspects. First and foremost, we have the human capital, because, as I said before, the company offers a comprehensive training program that provides employees the skills in order to thrive inside of the company. And also it includes a number of initiatives to support diversity and inclusion through also a competitive compensation program and benefits package. Regarding the governance, basically the supervisory board deliberate on the ACG matters, and also the committees deliberate and implement resolution. And the most important thing that is the company has a code of ethics that outlines basically not only the company's criteria and requirement, while also the company's expectation for its employees and values, I would say, for its employees and directors. Regarding the SEG rating, the NextEra Energy has an SEG evaluation score of 86 out of 100 due to its long history of environmental investments and its commitment to help the entire planet by reducing its gas emissions. Moving on to the next slide. Regarding the weaknesses and the challenges, we can say that the weaknesses basically are based on its dependence on Florida's market, due to the fact that basically half of the electricity generated by the company is basically produced in Florida. And the state also accounts for basically nearly half of the company's total revenue. Another challenge or weakness might be its exposure to weather events, especially for its power plants that are exposed to events such as hurricanes and tornadoes. Another challenge may be high debt levels and regulatory risk, due to the fact that the company's debt to equity ratio is basically nearly 50%, which is higher than the average debt to equity ratio for utilities. And that could also basically be a huge issue, not only financially, but also for the company in the future, because it might be more vulnerable to financial problems. And also its earnings may also decline due to these issues. And also competition is a huge challenge due to the fact that the renewable energy industry is growing a lot and is going to grow even more in the coming decades. And NextEra Energy, as a matter of fact, is facing huge competition from its peers. Now we leave the floor to my next colleague regarding the valuation part.
Going on with the valuation part, we decided to split our analysis into different valuation techniques based on two different valuation techniques. First of all, we decided to base our calculation on the multiple valuation based on three different indicators. The two main important one, the enterprise value on EBITDA multiples and the enterprise value on sales multiples. And then we decided to use really specific indicators for stock valuation, the P/SUI ratio, the price to earning ratio. And then this is just a quick introduction to the next slide. We decided to use an intrinsic value valuation technique based on DDM, dividend model valuation techniques. Go through. Now I'm explaining the valuation technique based on multiples. First of all, from Bloomberg, we extracted the pairs of competitor, and we created the basket of main competitors that in this case are based in the US market and are the main competitors of NextEra Energy. And we are talking about Duke Energy, a Southern company, Dominion and EKC. This company are the main four competitors. So I want to start with the enterprise value on EBITDA multiples with this study, and as we can see, we started from the medium value of the enterprise value on EBITDA for the main competitors, and then we calculated the estimation of the enterprise value at the end of the year 2022. We used the multiple multiplied by the 2022 EBITDA for NextEra Energy, and then applying the equity bridge formula, we calculated the left value of the equity from the enterprise value, and we essentially subtract the total debt, and we had cash to the enterprise value, and we obtained the left value of the equity. In this case, we are talking about $170 billion. That is quite in line with the estimation from Bloomberg. And we then divided this value from the total outstanding share, at the end of 2022, that is equal to 785 million of share. And then we obtained the left equity value per share, that is $21, and this is a very good indicator. It's higher than the medium value in the core market, and we are talking about $21. That is a really good value for a future growth of the share price. And then we applied the same methodology with the enterprise value on sales multiple, and we obtain a less value, but it is important to have a small specification. We use median value from this basket, and this valuation, it is not based only on the value for NextEra Energy. Then this is a focus based on a specific valuation metrics for share. We are talking about price to earning ratio, and from this calculation we can see that the estimated share price, the starting point of the share price is $45. I mean, it's quite in line with the value from the market estimation. It's a really good starting point for the future growth of the share, as we can see before with my colleague. We are talking about a really impressive growth in the P/E and the P/E ratio, and starting from this point will be really interesting to study the future growth. Going on, now we have the intrinsic value. It is based only on financials from the mother company, NextEra Energy. First of all, we based our valuation on the last day of June, the 30th of June 2023, and the closing price was $72.81 USD dollars. And from this value, we calculate based also on the CAPM and on the weighted average cost of capital from the previous slides. We calculated the range of our stock price, and we selected the perpetual growth rate, the fair value of the stock, and the cost of capital based on the CAPM theory. And then we calculated the current dividend per share, that is 1.87 USD dollars. And then based on our study on the core market, on the core business, on the financials, and also on the free statement of the firm, we then in this part estimated the future growth of the dividend based on our estimation. And finally, we obtain in this table the low, the medium, and the high value of the stock price. And in this little table here, we synthesize the three possible outcome for the stock price. It is based on the lowest scenario, and this is, I mean, not so fair, because we are talking about a super really fast growing sector in the global economy. And then we have the medium case scenario based on I mean, regular growth of the core sector. And then it is based on the best possible scenario case, I mean, super fast growing in the core market, and of course a really good situation regarding the total debt of the firm. And then in this part we just compute the perpetual growth rate. And this is all. To sum up, this is the last part with the three possible stock price. This was the last slide. Thank you for your attention,